Hello and welcome. In this video, we will try to understand what a dividend is. Okay? Now, why do you keep your money in a bank? You keep your money in a bank to earn some interest on it. Correct? So instead of having cash lying with you without doing anything, you can save it in a bank and earn some profit or interest on it. Correct? Now, why are you learning about stock market? You are learning about stock market so that you can invest your money in it and try to make some profit out of it or to increase your wealth. Correct? Now, dividends are payments a company makes to share its profits with its stockholders. Okay? Just like a bank pays interest on the money that you keep in their bank, dividends are the payments a company gives you if you have their share. Okay? It is a way of sharing the profit. Now, when we say profit, we need to know what profit is. Okay? So let us learn that first. Profit is equal to revenue minus expenditure minus tax to the government minus interest to the banks minus depreciation and amortization. Okay? Now, let us try to understand this with the example of oil mill. Let us say you are the owner of this oil mill. Okay? Now, what is expenditure? Expenditure is the amount that you spend to produce the oil and then to sell them to the customers. Okay? So, from start till the end, procuring coconuts, drying it, making oil from it, packing it, shipping it, all the prices that are involved in this comes under the head of expenditure. So, how much do you spend to make and sell your product? That is expenditure. Revenue is how much money do you get when someone buys your product. Okay? When I say someone, not a single person, how much money are you getting every month, let us take, or every year by selling the product? Now, how much do you get? Revenue. How much do you spend? Expenditure. Alright? Now, if expenditure is more and revenue is less, then you will be in loss. If revenue is more and expenditure is less, you will be in positive side. I cannot say profit, you will be in positive side. Okay? Because there are other things also. Now, after revenue and expenditure, we have tax to the government. So, you need to pay tax to the government from the revenue that you get. Next, you have taken loan from banks, correct? And an interest is levied upon it. So, you need to pay the interest to the banks, and that is paid from the revenue too. Next, we have depreciation and amortization. Now, do not worry much about this. Okay? So, if you have any machineries, so all those costs are divided and it is categorized under depreciation and amortization. Do not worry too much about this. But this also has to be paid from revenue. Okay? So, revenue minus expenditure minus tax to the government, interest to the banks, and depreciation and amortization. So, after reducing all this from the revenue, what you get is profit. For example, let us say revenue is 5,000 rupees. That is, this is the amount that you get when someone or when people buy your products. Or let us say this is the amount that you have got in an year. Okay, in a year. Minus expenditure 1,500. So, it has cost you 1500 rupees to produce oils in that particular year. You have paid 500 rupees tax to the government, 500 rupees interest to the bank, and the depreciation and amortization is 500. So when you do this, when you do the math, you get 2000 rupees as profit for that year. Okay, 2000 rupees profit for that year. Now, what to do with this 2000 rupees? Now, what to do with this 2000 rupees? This 2000 rupees belongs entirely to the stockholders or owners of the company. Now, who are the owners of the company? Owners of the company are the ones who have the stocks. So, in our case, these promoters are owners of the company, and the public who have the stocks of that particular company are also the owners of the company. Okay, and the profit 2000 rupees entirely belongs to them. Now, there are three options that the company has. One is to entirely distribute 2000 rupees to the stockholders. Okay, they can divide this, equally among the shareholders or stockholders and distribute it to them. Okay, if they do so, then the money that they are giving to the stockholders is called as dividend. Okay, dividend. So dividend is nothing but the profit that is shared or given to the stockholders of that particular company. Okay, now that is one choice that the company has. Apart from this choice, the company can reinvest this 2000 rupees back into the business. Instead of giving dividend, they can reinvest back into the business, hoping to grow the business. Okay, that is one case. Now, let us see if giving out dividend is better or reinvesting is better. Okay, with an example. Okay, now, so these are the three cases. Distribute entire profit 2000 rupees as dividend to stockholders, or second case, reinvest 2000 rupees in the company, or third case, do both, meaning some part of the profit can be given as dividend and rest can be invested back in the company. Okay, now let us see what happens if the company does this. Okay, so here are the cases. So case 1 is this: distribute 2000 entirely as dividend to stockholders. Case 2 is point number 2: reinvest 2000 entirely in the company. Okay, now first year, what happens? Investment is 8000 rupees. Okay, now what is this investment? Let me go back. 4000 plus 2000 plus 2000. Okay, so 8000 rupees. So we'll consider 8000 is the investment. Okay, investment, and in the first year 2000 rupees is the profit that the company makes. What is profit? We have seen the equation. Okay, and let us assume that 25% of the investment is obtained as profit. Okay, now if the company gives out entire 2000 rupees profit as dividend, first case dividend, then the retained earnings is 0. Okay, because the company has given all the profit as dividend. Now what is this retained earnings? Retained earnings is the profit that the company keeps to itself or retains with itself. Okay, now what does the company do with the retained earnings? It can do a couple of things which we will see later, and one of it is to reinvest back the money to the company. Okay, which is the second case we are assuming. Okay, we are assuming that retained earnings are reinvested in the company, although it can do few other things with the retained earnings, which we will see at the end of this video. Okay, so retained earnings is 0 in this case. So total money of the shareholders is 8,000. Okay, 8,000. Investment 8,000, total money is 8,000 because nothing has been reinvested back. So the profit is given as dividend. That's all. Okay. Next, let us see what happens in the first year. If we follow, or if the company follows second option, 8,000 rupees is investment, and let us take the same percentage as profit, 2,000. Nothing is given as dividend. So the company doesn't give dividend to the stockholders. Okay, and the company can do that. Remember that company need not compulsorily pay dividend to the stockholders. It is the choice of the company to pay or not to pay. Okay, and now in the case 2, let us say that the company reinvests entire 2,000 rupees in the company. Okay, so retained earnings is 2,000 rupees, dividend is 0. Okay, so how much money is with the shareholders? 10,000. So how is it 10,000? 8,000 is invested and 2,000 is invested. So whatever money is in the company belongs to the shareholders, correct? Stockholders. So it is 8,000 plus 2,000, 10,000 rupees. Now let us see what happens in second year. In the second year, once again, investment is 8,000. This has not changed. 2,000 is profit. 2,000 is given as dividend entirely. Nothing is reinvested back in the company. So at the end of second year, total money of the shareholders is 8,000. Okay, 8,000. Now, of course, the price of shares go up. Okay, of course, the price of share goes up. But let us say here it is same. Okay, it is same. In the second case, in the second year, 10,000 rupees is the investment, correct? 10,000 rupees. This is the investment because it is reinvested to the company to produce more goods, correct? So this is investment, and 25% of this is 2,500, which is the profit that they make by reinvesting the profit of last year. Okay, and once again, in the second year, they do not give any dividend to the stockholders, and everything is reinvested into the company. Okay, they retain the earnings. Now, what is the total money of the shareholders? It is 10,000 plus 2,500. It is 12,500. Okay, so at the end of second year, this is the total money of the shareholders. So same way, in the third year, investment is 8,000, profit is 2,000, entirely given as dividend, nothing is held back. So total money of the shareholders remains same. Whereas at the end of third year here, 12,500 is the investment, 3,125 is the profit, nothing is given out as dividend, everything is retained and invested back in the company, and so the total money of the shareholders is 15,625. Okay, so here in this case you can see that the total money of the shareholders has increased a lot when compared with this. Okay, so here the share price would have been tripled, or it may have been 4 or 5 times. Here it may have been increased by a small amount, or it may be same, or it may have decreased by value too. So you can see that by paying dividend, the company is not earning much. Of course, if we have the stocks of the company, we will be happy when we get the dividend. But dividend will be very less. Okay, if we as retail investors, if we have 100 stocks of a company, maybe we will get 1000 rupees as dividend, which is very less when compared with this. Okay, so here you can see that our investment amount has gone up in the value of shares. Okay, so this is why the company goes for third option. So some part of the dividend, some part of the profit is given as dividend, and rest is invested back in the company. Okay, I have kept the profit percentage same for all the years. Okay, just to make this simple for you. Alright, just to give you an idea of how the company can grow by reinvesting the amount or profit back into the company. Okay, yes. Now what is this retained earnings? What is this retained earning? Retained earning is nothing but the profit that the company keeps to itself to do something. Okay, to do something. Now to do what? To do what? To expand the company, let us say, maybe to expand the company and diversify, to go into new sectors. Okay, so this is what is meant by reinvesting in the company. Okay, so the company can opt for this. Now, sometimes the company issues bonus shares to the existing stockholders. Alright, so bonus shares, we'll learn about this in the next video. Do not worry about this. Okay, when the company do not have much of an expansion plan, then instead of reinvesting back into the same business, it offers bonus shares. Okay, or if the company do not want to expand or diversify, they give special dividend. Okay, special dividend is different from dividend. It is a one-time dividend. Okay, so this is one-time dividend which the company gives to the stockholders. Okay, so when we say retained earnings, it need not be used to reinvest back into the company and grow. So the company can do this or do this or do this. Alright, so generally it reinvests back to the company to grow the company. Okay, only when they do not have any other option to grow, if it is a saturated market, then they issue bonus shares and give special dividend. Okay, yes. So I hope you have understood what a dividend is. Dividend is nothing but the profit that the company shares with its stockholders. Alright, in the next video we'll learn what bonus shares are. Okay, so thank you for watching. I'll see you in the next video.